welcome to the deep dive. So today, I want you to just picture looking at a financial dashboard.
Okay, I'm picturing it.
And the numbers blinking back at you are like screaming two completely opposite stories.
Oh, I love these kinds of setups.
Right. It's wild because on one side of your screen, you see a stock price chart that basically looks like a rocket ship. It's August 14th, 2026, and the stock is trading at $63.32.
Which is a huge run-up.
Yeah, it's up an unbelievable 137% over the last 52 weeks.
Wow.
I mean, the momentum just looks absolutely unstoppable.
Yeah, it's the kind of technical setup that usually tells you, a company has completely figured out its market, buyers are just rushing in.
Exactly. But then you glance at the other side of your screen.
The fundamentals.
Fundamentals. You peer into the underlying business engine, right? And staring back at you is a trailing 12-month net profit margin of negative 141%.
Yeah, that is not a typo.
It's not. We are talking about a business that is deeply, painfully bleeding cash, not just slightly unprofitable.
Right. It is one of the most honestly fascinating financial paradoxes in the market right now. You have an asset that day traders are enthusiastically buying up, while the accountants are essentially pulling their hair out over the actual balance sheet.
And that asset is Moderna.
Yep.
So we have a massive stack of sources on the table today for you. It's anchored by this really comprehensive equity research report from August 2026.
It's a great report, too.
It is. It covers their technical charts, their fundamental balance sheet, and the overall market sentiment.
Right.
So our goal today is to unpack this intense tug of war. How does a stock perform so well technically while the underlying financials look so, grim?
Yeah, we're going to trace the massive scientific breakthroughs they just achieved and then dig into the harsh reality of their cash burn.
And figure out what it actually means for the future of a company that is, really trying to prove it's more than just a pandemic-era phenomenon.
Exactly. So if we want to understand why the stock has practically doubled from its 52-week low, we have to look at the massive hurdles they just cleared.
Because the market isn't just throwing money at this chart blindly.
No, definitely not. There's real institutional weight behind it. Let's start by looking at that chart. The research notes that the stock is in a sustained uptrend.
Trading well above its moving averages, right?
Yeah, it's above its 20-day, its 50-day, and its 200-day simple moving averages.
Okay, so for anyone listening who doesn't, stare at technical analysis all day long, what is the actual mechanical significance of those three specific lines?
It basically all comes down to consensus across different time horizons. So the 20-day moving average, that reflects the mood of short-term traders.
Right.
The 50-day captures medium-term sentiment. Yeah. But that 200-day moving average, which, by the way, currently sits way down at roughly $46, that is the institutional baseline.
Okay, got it.
So when a stock is trading above all three of those, it means the day traders, the swing traders, and the massive pension funds are all in total agreement.
Oh, wow. So they're all aligned.
Exactly. The momentum is genuinely upward. There is no internal conflict in the market's pricing mechanism.
But I mean, the chart is just a shadow of the real world, right?
Right.
Something had to trigger all that institutional buying. And our sources point to August 5th, 2026 as this massive catalyst. The FDA officially approved MFL-Luciva.
Yes, MRNA 1010.
Exactly. They're vaccines specifically for adults 50 and older.
And look, we really cannot overstate the historical weight of this approval.
Right.
This isn't just another generic flu shot making its way to your local pharmacy. This is the first and only mRNA standalone seasonal influenza vaccine to ever hit the market.
Okay, I want to pause on that because I think it gets to the absolute core of the entire Moderna narrative.
Yeah.
Since 2021, the market has essentially treated them with a bit of suspicion.
Oh, absolutely. The overarching question was basically, okay, you pulled off a miracle with the COVID vaccine, but are you just a COVID company?
Right. Is mRNA an actual repeatable platform, or did you just get lucky once?
You hit the nail on the head. The market needed proof of concept beyond a once-in-a-century pandemic because COVID was a highly specific, highly urgent target.
And the flu is not that.
No, the seasonal flu is notoriously tricky. It mutates constantly. The strains shift every single year.
Right.
So by getting a seasonal flu vaccine approved, Moderna basically validates the underlying mechanics of their entire platform.
Oh, I see, because it's a moving target.
Exactly. They prove they can identify a moving target, sequence it, manufacture the mRNA instructions, and successfully navigate the incredibly strict FDA approval gauntlet.
For a non-emergency product.
Precisely. That's the key.
So it fundamentally transforms how investors view them. They go from being this potential one-hit wonder to actually having a validated commercial pipeline.
Yep. And while they were locking in that scientific validation, they also managed to clean house legally.
Oh, right, the lawsuit.
Yeah. The research highlights that they finally settled the Arbutus lipid nanoparticle patent litigation.
Which has been this massive, looming threat for years.
Serious threat.
But let's break down the science of that lawsuit for a second, because I feel like it explains why settling it was such a big deal. The dispute was over LNP's lipid nanoparticles.
Right.
What are those, and why did Arbutus, having a patent claim on them, threaten Moderna's entire business model?
So imagine mRNA as a highly sensitive, incredibly fragile message that you need to deliver to a cell.
Okay.
If you just inject raw mRNA into the human bloodstream, the body's immune system will instantly recognize it as foreign debris.
And just destroy it.
And shred it to pieces before it ever reaches the cell.
Yeah.
It's way too fragile to survive the journey on its own.
So it needs a delivery vehicle.
Precisely. It needs an armored truck. And that armored truck is the lipid nanoparticle. It's basically a microscopic bubble of fat that encapsulates the mRNA, protects it from the bloodstream, and allows it to slip safely inside the human cell.
Wow, okay. And Arbutus claimed they owned the patents on the design of those specific armored trucks.
Exactly. So even if Moderna owns the brilliant mRNA message inside, it doesn't matter if they are infringing on the patent for the only truck capable of delivering it.
Oh, I see. So a total loss in court could have meant, like, forfeiting a massive percentage of their future revenues to Arbutus.
It could have been devastating. So settling that suit essentially removes an existential threat from the board. It allows them to control their own destiny again.
No more massive legal cloud dictating their valuation.
Exactly.
Okay, but hold on. I need to play devil's advocate here based on the data in front of us.
Let's do it.
If they just achieved the holy grail of biotech, proving their platform works on a complex seasonal virus, winning FDA approval, clearing an existential legal threat, why does our research packet show an overall sentiment rating of just 5 out of 10?
Yeah, the neutral rating.
Right. A 5 is completely neutral. The stock is up, the science works, the lawyers are happy. What is the catch here?
Well, the catch is the sheer brutal reality of what it actually costs to achieve those victories.
The cash burn.
The cash burn. Winning scientific and legal battles is unfathomably expensive. And their balance sheet is taking an absolute beating right now.
Yeah.
When you look at the fundamental analysis in our sources, it paints a very grim picture.
So let's talk numbers then. Walk me through the actual revenue drop, because looking at the report, it looks like they drove off a cliff.
They essentially did. In the second quarter of 2026, their revenue was just $145 million. Yeah. Total revenue for the entire first half of the year was $534 million. Put that in perspective, their trailing 12-month revenue growth is negative 27.62%.
So we are looking at a serious post-pandemic revenue drought.
A massive drought.
But dropping revenue is only half of the equation that gets you to a negative 141% profit margin.
Right.
The real issue is the expense side of the ledger, isn't it?
This is where the numbers get truly staggering. Their net loss for the first half of 2026 was negative $2.125 billion.
$2 billion lost in 6 months. That's wild.
And we have to look at how that impacts their actual bank account, what's called operating cash outflow.
Okay.
This is an abstract accounting depreciation. This is the actual physical cash leaving the business to pay scientists, run clinical trials, and, keep the lights on in the labs.
Right, the real money.
Exactly.
Yeah.
That outflow was negative $1.156 billion for the first half of the year.
Wow. It makes me think of a movie studio that spent $1 billion building this incredibly advanced, state-of-the-art CGI rendering engine.
Oh, I like this analogy.
Right. So they used it once to make a massive multi-billion-dollar blockbuster, their COVID vaccine.
Yep.
Now, they've used that exact same expensive engine to make a brilliant indie film about the flu.
Right.
And the indie film is great. The critics love it. The FDA just gave it an Oscar. But selling tickets to an indie film isn't going to cover the massive overhead costs of running a $1 billion CGI studio.
That is a phenomenal way to visualize it, because the platform infrastructure they built is world-class. But carrying the cost of that infrastructure while revenues are down at $145 million a quarter.
Just unsustainable.
Completely unsustainable.
Yeah.
In December 2025, they had about $2.6 billion in cash and cash equivalents.
Okay.
By June 30th, 2026, that dropped to $1.72 billion.
Oh, wait, and that Arbutus patent settlement we just celebrated?
Yeah.
The one that cleared the legal dark cloud. The sources note that it required a $178 million payment right out of the gate in July 2026, right?
Correct. Which means that June 30th cash balance of $1.72 billion is actually even lower today.
Because that massive settlement check hadn't cleared the bank yet when the quarter ended.
Exactly.
Okay, so this brings up a massive discrepancy in the research that I really need you to explain.
Okay, what is it?
If they ended June with roughly $1.7 billion in the bank, and they just had to write a nearly $200 million settlement check, and they are actively burning through $1 billion in operating cash every 6 months,
Right.
how on earth is management maintaining their official guidance that they will end the year 2026 with $4.7 to $5.2 billion in cash? The math just does not work.
No, it doesn't. And that is exactly the multi-billion-dollar question institutional investors are asking right now.
So how do they bridge it?
To bridge a gap that wide, a biotech company essentially has 3 levers they can pull. First, they could be banking on an absolutely historic, unprecedented revenue ramp in the second half of the year from the new MFL-UCIVA launch.
Which, I mean, seems highly optimistic for a brand new flu shot, right?
Extremely optimistic. It takes time to build that market share. So the second lever involves balance sheet maneuvers.
Like what?
Things like monetizing future royalties, getting massive milestone payments from pharmaceutical partners, or just selling off non-core assets.
Okay. And the third lever?
The third lever is the one current shareholders absolutely hate the most.
Issuing new equity.
Issuing new equity.
Yeah.
Diluting the stock. They could be planning to sell millions of new shares to the public to raise that cash.
Oh, because the stock is so high right now.
Exactly. When your stock is up 137%, management often views that as an attractive time to raise capital, even though it dilutes the value of everyone else's shares.
Right. So the market is holding its breath to see which of those 3 levers management actually pulls to hit that $5 billion target.
Yep. Which means execution over these next few months has to be completely flawless.
Because when you are running a cash deficit this severe, you literally cannot afford a single misstep.
No, you can't.
But the research points out that there are roadblocks already forming.
Significant ones. Let's look at pipeline execution risks first. The report highlights a delay in their Phase 3 norovirus vaccine trial. That's MRNA 1403.
And in the biotech world, time is quite literally money.
Oh, absolutely.
If a clinical trial is delayed by 6 months, that is 6 solid months of paying lead scientists, funding laboratory overhead, and managing trial logistics.
Without a commercial product coming to market at the end of it to recoup those costs.
Exactly. So every delay just deepens the cash burn.
Yeah. But beyond internal trial delays, there are external forces at play too. Market dynamics completely out of Moderna's control.
Right.
And our research highlights a major structural shift in their total addressable market.
Okay, now, regarding this next point from the sources, we are going to look at a recent government policy shift regarding childhood vaccine schedules.
Yes.
And to be completely clear to you listening, we are looking at this purely through the lens of market mechanics and demand forecasting. We're not taking any political sides here. We're not endorsing or criticizing the administration.
No, absolutely not. Just looking at the numbers.
Right. So mechanically, how does this policy actually alter the financial model?
So mechanically, we are talking about what analysts call the TAM, the total addressable market. The administration recently narrowed the core childhood vaccine recommendations down to just 11 specific vaccinations.
Okay.
And in doing so, they explicitly removed COVID-19 and influenza recommendations for all children.
So purely in terms of the healthcare sector, what happens when a vaccine is removed from that core pediatric schedule?
It fundamentally erodes automatic demand because when a vaccine is on the recommended core schedule, it triggers this massive domino effect of institutional purchasing.
Ah, I see.
State health departments buy it in bulk. Pediatricians just automatically stock it in their fridges. Schools require it for enrollment, and insurance companies are mandated to cover it seamlessly.
So it essentially acts as a guaranteed distribution pipeline.
Exactly. It's a machine. By removing the COVID and flu vaccines from that universal core recommendation, that automatic institutional pipeline basically shuts down for those products.
Wow.
It doesn't mean parents can't still get the vaccines for their kids, but it shifts the burden completely. Suddenly, Moderna has to market directly to consumers.
Which is way harder.
Way harder. The friction to get the shot increases. Pediatricians might not pre-order as much inventory. And the total volume of guaranteed arms just shrinks by millions.
Man. So you take a company already facing a massive post-pandemic revenue cliff, burning cash at an alarming rate, and you suddenly shrink the baseline demand for their two primary products in the pediatric demographic?
Yep.
That is a heavy blow to their revenue forecast.
It is a profound external shock to their financial modeling, no doubt about it.
All right, so let's bring the technical momentum and this brutal fundamental reality together.
Yep.
Because we're sitting at a tipping point. The stock is up 137% over the last year, but the bank account is draining fast. And the total addressable market for kids just shrank.
It's a lot of tension.
It is. So if you're listening and looking at this chart at home, what should you be watching for over the next 6 to 12 months? How does this tension resolve?
The very first thing you have to consider is what the market has already digested.
Right.
We look at the RSI, the Relative Strength Index.
Okay.
The stock currently has an RSI of 66.38.
And just for context, an RSI above 70 is generally considered overbought.
Right.
It basically means the buying momentum is running extremely hot. So at 66, we are getting very warm.
Very, very warm. When you combine that high RSI with 137% annual gain, the mechanics of the market tell us that the good news is already priced in.
Ah, so you missed the boat if you're buying on old news.
Exactly. The traders have already bought the MFLU's Flu approval. They already priced in the Arbutus lawsuit settlement. You can't buy the stock today expecting a bump from things that happened a month ago.
Okay, so the easy money on the rumor has been made. Now comes the reality phase.
Right.
What is the first major catalyst that could actually swing this chart moving forward?
Catalyst number one is definitely the commercial launch dynamics for MFLU this fall and winter.
Okay.
It is one thing to convince an FDA panel that your science works. It is an entirely different challenge to manufacture millions of doses, distribute them flawlessly to pharmacy chains, and actually convince adults, 50 and older, to choose your brand new mRNA shot.
Over the traditional flu shot they've been getting comfortably for 20 years.
Precisely. It is the ultimate prove-it moment.
Right. Going back to our analogy, you built the studio, you won the Oscar for the indie film, now you actually have to sell the movie ticket.
Exactly. If the initial pharmacy distribution data shows strong adoption, the bulls are validated, the revenue starts flowing. But if the adoption lags, or if there are supply chain hiccups, that cash burn we talked about becomes completely terrifying.
Wow. Okay, what's catalyst number 2?
This one is arguably even more critical for the long-term valuation of the company. The research points to highly anticipated 2026 clinical data for their oncology pipeline.
Oncology, like cancer treatment.
Yeah,
Wow.
Specifically a candidate called MRNA 4157.
Now, why does the market view cancer applications as the true holy grail for mRNA? Like, even more so than these seasonal respiratory viruses?
Because seasonal flu shots are essentially low-margin commodities.
Oh, sure.
They are vital, obviously, but you sell them once a year for a relatively low price. Oncology is an entirely different financial and medical universe.
Also,
We were talking about personalized cancer vaccines. The mechanism is fascinating. They take a biopsy of a patient's specific tumor, sequence the unique mutations of that exact cancer, and then use the mRNA platform to print a custom set of instructions. They inject that back into the patient, essentially teaching their immune system to hunt down those specific cancer cells.
so it's completely bespoke personalized medicine.
Precisely. If Moderna can release positive interim or final data proving this works, proving they can actually treat or prevent certain cancers, it completely rewrites their valuation model.
It proves the platform's versatility and high-margin, life-saving therapeutics.
Exactly. We are also waiting on updates for a combined flu and COVID single-shot vaccine, which would solve a lot of consumer fatigue issues. But the oncology data, that is the massive prize.
It sounds like it. But both the commercial flu launch and the oncology research require one thing, right? Survival.
Yep. Cash.
Which brings us to the final looming catalyst, the Q3 and Q4 cash trajectory.
It all comes back to that $5 billion guidance.
Yeah.
The market is going to be analyzing their next earnings report with a microscope.
Investors are going to be looking to see which of those 3 levers they pulled.
Exactly. If the cash balance tracks upward toward the midpoint of their guidance without massively diluting shareholders, it signals that management has a masterful handle on the burn rate and alternative financing.
Right.
But If that cash balance falls materially below the low end of their guidance, or if they announce a massive dilutive stock offering,
The bear case strengthens immensely.
immensely, that 137% technical gain could evaporate very quickly if the market just loses faith in the balance sheet.
So let's step back and look at the whole board here.
Okay.
You are looking at Moderna. This is a company with undeniably brilliant, historically validated science.
They conquered COVID.
Right. And now they've engineered the first ever mRNA seasonal flu vaccine. They are winning in the lab,
Big time.
but they are operating with a deafening ticking clock on their financials, bleeding over $1 billion in actual operating cash in just a 6-month window.
It is the ultimate tension between limitless scientific potential and the harsh gravity of corporate finance. The science is soaring, but the balance sheet is basically an anchor.
And reading through this equity report leaves you with a really fascinating, broader question to ponder on your own.
Oh, for sure.
When you look at Moderna today, it doesn't look like a traditional, slow-moving pharma company, right?
Yeah.
But it also doesn't look like the pandemic superhero of 2021 anymore either.
No, it's somewhere in the middle.
Are we simply witnessing the incredibly painful, massively expensive adolescence of a company? Like, they are trying to evolve from a one-hit wonder tech darling into a mature, diversified biopharma giant.
And that evolution just costs billions of dollars.
Exactly. So the question you have to ask yourself as you watch this stock over the next year is this: at what point will the market stop treating them like a hyper-growth tech startup?
Right, forgiving these massive billion-dollar losses for the promise of world-changing future science.
And start demanding the steady, predictable, boring revenues of a traditional pharmaceutical company?
Because eventually, the infrastructure has to pay for itself. The market will only fund a negative 141% profit margin for so long before it demands to see the actual returns.
The ultimate paradox. Brilliant science, brutal math. Keep an eye on those pharmacy adoption numbers as we head into flu season. They might just be the tiebreaker. Until next time, keep digging.